Have you ever wondered how something as beautiful as a flower could lead to one of history's most fascinating financial meltdowns? Investor panic significantly hastened the tulip market crash by triggering a rapid, widespread loss of confidence among buyers, transforming an already overvalued market into a freefall of collapsing prices. Once a few sellers accepted lower bids, the psychological shift from speculative euphoria to acute fear spread contagiously, leading everyone to try and sell at any price before their assets became worthless. The core mechanism behind this acceleration was a powerful feedback loop driven by human psychology and market structure. As prices began to dip from their unprecedented highs, early speculators who had made paper fortunes realized the precariousness of their positions. The market for tulip bulbs, particularly the rare varieties, relied heavily on forward contracts and promissory notes rather than immediate physical exchange, amplifying the fragility. When initial price declines occurred, the realization that there were fewer actual buyers at previous high prices prompted a rush to liquidate these contracts. This created an overwhelming supply of phantom tulips in the market, with a rapidly diminishing pool of buyers willing to pay inflated rates. Understanding this historical event helps us recognize the telltale signs of speculative bubbles in modern contexts. To observe how panic contributes to a market crash, you should track asset prices relative to their intrinsic value, monitor media sentiment for signs of irrational exuberance or fear, and observe trading volumes for sudden spikes during downturns. A rapid increase in volume during a price drop often indicates widespread selling driven by fear rather than fundamentals, a characteristic very much present during the tulip crash. Interestingly, the Dutch government initially tried to intervene by converting forward contracts into options at a lower, but still inflated, price. This attempt to stabilize the market actually backfired, legitimizing the idea that the bulbs were not worth their prior valuations and prompting even more frantic selling. The sheer speed of the collapse, which took place over weeks rather than months, highlights the critical role of behavioral economics in market dynamics. The term Tulip Mania itself became synonymous with irrational exuberance, enduring 4 centuries as a cautionary tale. Ultimately, the tulip market crash serves as a vivid historical lesson that investor confidence, or the lack thereof, can be a more potent force than underlying value in determining market outcomes, especially during speculative frenzies. By understanding how collective fear can dismantle a market so swiftly, we gain valuable insights into the psychological underpinnings that continue to shape financial markets today, emphasizing the need for rational analysis over emotional reactions.